Good afternoon. Time to have a look at what's happening from a markets perspective. Asian markets largely higher as investors in that particular region reacted to the Bank of Japan's monetary policy decision. Nonetheless, when we look at our JSE markets, firmer in line with global peers. This again as investors digest the monetary, rather economic support from China. When we look at the indices in terms of how they're performing, our all-share index up 1.6%. led by the resources that are 2.9% higher, and then followed quite closely there by the industrials up 1.25%. Looking at what happened on Sense today, we did get a trading update from Discam indicating that they are expecting profits to be a little bit higher. What was interesting though about that share price reaction, that share was up 3.4%. However, it has come down slightly, down 2.9%. We did also have Clicks releasing their interim figures, hiking their dividend, at the same time increasing pharmacies and expanding stores, and that particular share price was up 0.5%. It's come down 0.25%, possibly due to some profit taking in that respect. However, we are going to be talking to the CEO of Clicks, Bettina Engelbrecht, a little bit later on in the show. But to talk to us about the latest when it comes to global market developments, we are joined by Han Tan, who is the Chief Market Strategist at Xfinity. Han, thank you so much for your time. I suppose let's start off with looking at what the key themes and concerns for financial markets seem to be at this point of time.
I think right now the headlines, are mostly dominated by the Fed's tightening path, right? On one hand, you've got markets trying to decipher what the Fed intends to do, and then what markets think that the Fed can actually do, right? So I think that dilemma is set to play out over the coming months. And of course, we've got that slowdown in China, given the ongoing lockdowns that's feeding into market worries as well. And of course, we still have that war between Russia and Ukraine and its impact on commodities and global inflation that's being digested as well.
When we look at our South African rand, I mean, no doubt that the dollar is king at this particular point. Are you expecting a longer suppose an increasing period of dollar strength here? And what does that then do to some of the expectations you may have for other currencies?
Yeah, so the short answer is yes, we do expect this stronger dollar environment to persist as long as, again, the Fed continues with its hawkish stance, and also more importantly, the markets believe that the Fed can indeed proceed with those intended rate hikes and tapering of its balance sheet, right? So what that means for the rest of the FX universe, that implies more downward pressures. We are already seeing that across the G10 space, Asian currencies, EM. So if you look at the euro and the pound, for example, they're trading at multi-year lows. So it indeed is a shift for the FX markets, and my projections from what I had earlier, given the more overtly hawkish stance, more aggressive stance that the Fed has adopted in recent months.
I indicated in my intro that we had the Bank of Japan announcing its monetary policy decision, leaving it unchanged. And I'm wondering whether that was in line with your expectations, and also how the yen reacted to that announcement.
Yeah, now overall their statement, yes, was in line with market expectations, leaving their accommodative stance unchanged. But perhaps what surprised markets a little bit was the BOJ's refusal to actually start intervening in the yen. In other words, allowing or tolerating the yen. And that's why we saw the dollar yen cross above 130 today. And that is sending a surge, a wave of demand towards the US dollar that's then keeping pressure, downward pressure on the rest of the FX complex as well. So I think, as long as this policy divergence between the Bank of Japan, the Fed, and other central banks, as long as that divergence persists, then we should expect more yen weakness in the recent months ahead.
From some of the conversations you're having on that point of that policy divergence, does it make sense for the BOJ to not hike at this particular point? Or do you believe that they, rightfully so, they are taking a cautious stance? Where do you sit when it comes to their monetary policy approach?
Yeah, when it comes to their monetary policy approach, markets are certainly struggling to understand why the Bank of Japan is insisting with its yield curve control, right? So capping those 10-year yields at 25 basis points when the rest of the world is, again, allowing their yields to spike higher. So the outlet for that kind of pressure is then seen in the yen, right? So it's a kind of give and take. In order for the BOJ to persist with its accommodative stance, the yen has to give way. Now, it may make sense because from a historical perspective, even when dollar yen hit 135, you saw policymakers not intervening, right? So it assumes that there can be more yen weakness to be tolerated along the way. So on top of that, I think Tokyo is more willing to use other policies to help cushion the Japanese economy. So perhaps more on the fiscal side, more so on the monetary side.
As we wrap up our conversation, what do you make of U.S. earnings season so far?
Yeah, overall, it has been better than expected. We saw that out of the Wall Street banks a couple of weeks ago, and from the big tech names that have reported so far this week, we're seeing a similar theme. But having said that, that could be a double-edged sword, right? Whereby if these U.S. companies report better than expected earnings, that in turn gives the Fed more leeway to be more aggressive in their rate hikes. So while we are seeing stocks perhaps recover on the back of these better than expected earnings, that may be short-lived in the event that the Fed actually signals a more hawkish stance by its policy next week and its meetings in the months ahead.
Han, let's leave it there. Thank you so much for your time. That is Han Ten, who is the Chief Market Strategist at Xfinity, giving us his perspective on the latest market developments. A little bit later on, I'll have that interview with the CEO of Click, so stay tuned. Welcome back. Pharmacy retailer Clicks reported interim earnings that were up 26%, retail sales increasing 13.6%. However, the group did warn that the second half could bring trading conditions that are constrained as consumers battle with financial pressures. To give us a little bit more color on the financials this afternoon, we are joined by Bettina Engelbrecht, who is the CEO of Clicks. Bettina, thank you so much for your time. Let's look back at the 6 months that was. How would you characterize it?
We're very pleased with the results, Natasha. And I think what it also has done, it's confirmed that our business model is resilient and that the categories in which we trade are defensive and growing. Coupled with that, of course, we have a phenomenal Club Card customer base of over 9.5 million loyal Club Card customers who made up 80.5% of our sales.
Right. So one of the key interesting aspects was that you've opened your 800th store in March. Is there a target in terms of a number of stores that you plan to roll out? And what does that mean from a space growth point of view?
Well, I mean, the target that we've put into the market is to grow the store base to 900. I think the pace at which we've run over the last 2 years probably says it's time for us to reevaluate that particular target. So we opened up the 800th store in March. And in fact, today we're opening up 3 new stores, one in George, one in Roodepoort, and one in Claremont here in the Western Cape. So I would say that we are very well on track to exceeding the ultimate target that we've given to the market, to the extent that we'll be re-evaluating that particular target. Importantly, Natasha, in the course of this year, we will open 45 new stores and 54 new pharmacies.
What's your sense of the consumer appetite for your Clicks baby stores?
It seems to be doing really very well. I think that the benefit is, I think it's the whole ambience that we've created in the Clicks baby store. It's a showroom and it's intended to be a place where the mum or baby shopper can go and browse. There's great support in terms of people that's able to provide advice, and you can test, you can touch, you can feel the product. But importantly, the teams have thought about it from the perspective of a person that's got limited time. So you've got a feeding station in the store, you've got a baby changing station in the store, and you've got Wi-Fi in the store, which means that, if you've got a question or you want to place the order right there and then, you are able to do so. And you can connect with family or friends when you're in the Clicks Baby store. Just, in terms of a question, people often want to do their baby showers and say, well, I've seen these products, what do you think about it? So all in all, great appetite. And of course, babies are being born as we speak.
In an environment where we're talking about global supply chain issues, is there an impact going forward from Clicks when it comes to a sourcing point of view?
Well, we actually have a very limited range that we source offshore. And the reason for that, of course, that's aligned to our localization strategy, where we are committed to saying, what is it that we do to support the rejuvenation, if you will, of our economic recovery in this country. And so we have always been quite adamant that we wish to support localization. Having said that, though, no one escapes the impacts of any particular global event. We've seen that with the pandemic, and we most certainly are seeing it with the Russia-Ukraine war, and the impact that that has had on, or is having on, fuel prices, which is quite important to us because one of our large business units really has to deliver and distribute life-saving medication to hospitals, pharmacies, and clinics across the country. So, that's the impact. What I would say to you, looking at some of our private label suppliers, is that, of course, there are inputs that come from global firms into South Africa. And if anything, if there's a constraint, it's actually the input factors that come from overseas that will be impacting us. So indirectly, but directly, it's in terms of rising prices of fuel that will be impacting us.
When you look at the second half of the year, what does that look like from a guidance point of view in terms of the number of vaccinations? Are you expecting that to wane a little bit?
We have already seen over the last sort of 2 months that there has been a decline in the vaccinations. We, though, have not built our guidance based on an equivalent level of vaccinations going forward. Rather, the very reason we decided to put our hand up and support the national vaccination program as strenuously as we have is because we always understood that what would happen is that if people were vaccinated, even though they could still become infected, it would not be as severe and it wouldn't have the impact on both lives and livelihoods that we have seen. And we most certainly can already see the easing of the restrictions and the opening up of the economy is having a very positive impact on certain of the categories in which we play, such as, for example, beauty and personal care.
Before I let you go, Bettina, the outlook for the second half of the year.
Well, we've put an outlook out there. We never know what's going to be happening with load shedding. I think that's the one. And of course, I think, our hearts go out for the people in KwaZulu-Natal because there's a huge rebuild effort that needs to take place. And we are doing our part to ensure that we are supporting that as well. But the outlook is still a buoyant outlook. We are going to still invest 565 million rand in capital expenditure, specifically on stores, new pharmacies, and refurbishment, as well as, of course, the restoration of those stores that had been damaged in July of 2021. So all of that comes into this particular year. But we are optimistic because we can see the opening up of the economy and the recovery of some very critical categories. And then, of course, I think just finally what I would say is that we have, if you will, as a drugstore, we've got a second peak trading period that lies ahead of us. Now, over the last 2 years, we have not had a winter season, and we've not had the acute infections that come with the winter season. When we look forward now, we fully expect to see a winter season that is more representative of what we had in 2019. So good cause for us to say we expect to see good double-digit growths on the strong side for the full year.
Bettina, thank you so much for your time. That is Bettina Engelbrecht, who is the CEO of Clicks.